Unstoppable. Relentless. It's the ironclad investment discipline. How to get money out of your RSPs, your RRIF, your 401k, your IRA, and pay the least amount of tax. In this short video, I'm going to share something that probably flies in conventional wisdom's face, which is that you should put money into your registered plans, whether you're in Canada or the US, leave that money in there until you're in your 70s and you're forced to take money out, and that's the way that you should do it. For a lot of our clients, there's an opportunity to take money out of their 401ks, their RSPs, before they have to in their 70s and pay significantly less tax than they otherwise would. And so let me just give you some backdrop of RSPs, 401ks for those of you, just so we're all on the same footing. You put money into these plans while you're working and you get a tax deduction based on your marginal tax rate the year that you put it in. So if you're here in Ontario and you're in the 53.5% marginal tax rate, you put $1 in, you're gonna save 53.5 cents for every dollar that you put in. And in theory, you let your money then grow. There's no report of buildup. There's no taxation on the earnings that you earn in your lifetime inside of that RSP or 401k. And then when you're in your 70s, you're forced to start pulling money out. And for a lot of people, they're going to be in a lower tax bracket in retirement than they are now. I'll give you an example. Let's say you're in a 30% tax bracket in retirement. You put money in, you got a 53.5 cent tax deduction, and then you only pay tax at 30% later on down the road. A wonderful strategy. For a number of our clients, there's an opportunity before they have to in their 70s where they can start pulling money out of their RSPs, 401ks prematurely at a far lower tax rate than they would if they wait until they're in their 70s. So I'm going to walk you through an example that I think will hopefully highlight this. So I have a client, I'm going to disguise her name for obvious reasons, but her name is Melissa. Melissa has $1 million in round terms in her RSP with us. She also has a taxable account worth $1.6 million. She's 62 years old. She's not collecting any Canada pension. She's not collecting old age security. Her only source of income is whatever we earn in her taxable account. And this year, in 2023, she had approximately $56,000 of realized capital gains on stocks that we sold throughout the year. She has to add half of that to her taxable income this year. So she's got a taxable income of about $26,000. And she pays us a fee of $16,000 on that taxable account. So we can deduct that. So she's got $26,000 of income, $16,000 of fees. Her taxable income is only $10,000. That barely puts her in a 20% marginal tax rate. So we said to Melissa, you can pull money, you can get your taxable income up to $48,000 in Ontario and pay tax at 20%. That's where the marginal rate starts to kick up to 30%, then 40%, then 48%, then 53%. So I suggested to her, let's take $30,000 out of your RSP. You don't have to, but let's do it prematurely. You'll pay tax at 20%. And when we run her financial plan and we forecast what her taxable income is going to be in the future, if we don't do this, she's going to be forced in her 70s to pull money out of her RSP, and she's going to, through a RRIF, her taxable income is going to be well over $100,000. So now she's in a 40% tax bracket, not 20%. And once your taxable income goes over $84,000, which in this case clearly it will, you lose out on old age security. It starts to get clawed back. It's a government benefit, $8,000 a year that you qualify for if your taxable income is below 84. So if we do nothing, Melissa's going to have to pay tax at 40% when she's pulling money out of her RSP or RRIF later on in life, and she's going to lose out on her old age security. So this is a great strategy for her. We took the money out, we recommended it, she agreed to it, we did it, and she paid tax at half the rate that she would otherwise. So there's a huge opportunity for people, and it all starts with a financial plan. And by the way, she doesn't have to spend that money. All we're doing is moving the money from her RSP to her taxable account. She doesn't have to spend it. In her case, we are sending her monthly income, so we're just replenishing some of that monthly income that we send to her throughout the year. But if you don't need to spend the money, You don't have to spend it. You just move it into the taxable account. And again, this all starts with having a written financial plan that clearly forecasts what your taxable income is going to be in the future. And so if you don't have a financial plan, well, you can't do this analysis. And so if you're a client of ours, you probably recognize this strategy because we probably had a conversation about it for those of you that it's applicable to. If we haven't had a conversation, it's because we've run the numbers and it doesn't make sense. So we do run the numbers for a lot of our clients and it doesn't make sense to take the money out prematurely, but often it does. And if it does, we clearly do that. Which leads me to those of you who might be watching this video who are not clients of ours. The business, I started in this business 30 years ago, and when I first started, it was all about investments. And it's still a big chunk of what we do today is helping clients to manage their investments, but that's such a small part of the overall wealth management picture. So if you have an advisor and you are just talking about investments and you're not going through this type of analysis to identify tax planning opportunities, I would argue you're probably missing out on some opportunities, and I would welcome a call. Here at Greenlee's Wealth, investment discipline as well as wealth management discipline are the cornerstone of what we do for our clients, and I would love the opportunity to have a conversation with you about that. At any rate, I'll close by saying conventional wisdom, put money in your RRSP 401k and then take it out of your IRA and your RRIF later on when you're in your 70s. For a lot of clients, there's an opportunity to take the money out prematurely, and by doing so, you pay a lot less tax. Hopefully this hasn't been too confusing and that it sheds some light on the concept. I'd be happy to have a conversation with you if it's still not clear. Otherwise, I appreciate you watching our short video and I hope that it's been helpful.